You are listening to the Marc Guzman Podcast Experience.
Welcome to another episode of Keeping It Realty with Marc and Brian. And we've got some very interesting topics to discuss this week. And before we get into the first topic, big shout out to our beer sponsor, East Brother Beer Company, located in Point Richmond, California. Definitely worth checking them out. So a lot's been happening here in the last week since we did the last episode, and I think we should just get right into the very first topic, which is what everyone's really talking about, and it's this inverted curve yield.
Mm-hmm. Yeah, in fact, well, everyone in prior episodes, we've been talking about the possibility of a recession and whether it's looming and, what type of a recession. And of course, now this yield curve inversion has loomed and people are beginning to panic. So what does it mean?
So it's very interesting, but basically, and this could be a whole topic in itself, a whole discussion, way longer than 5 minutes, but an inverted yield curve is when short-term rates are higher than long-term rates. Typically, your short-term rate where, let's say, a bank's going to lend to another bank, or you have a 3-month, 10-month, 1 or 2, 3 year, some kind of investment asset, your rates are going to be very low because it provides a lot more stability. Whereas if you're going to tie up your money in long-term debt, 10 years, 30 years, you want some type of premium to cover that, tying up your money for that long of a time frame.
And just to simplify things a little bit more too, what we're talking about is the bond. The bond that the U.S. sells, different types of bonds, double tax-free municipal bonds, U.S. Treasury bonds. The yield on that has dropped because when these things are sold, they're also traded on the open stock market, very similar to securitized debt. And sometimes the cost of that original bond will go up, therefore their return on that bond will go down. And that is when it begins the inverted yield curve.
So a lot of people are scared about this because historically, and this kind of depends on which economist you talk to, but some economists say historically an inverted yield curve, too long of a time frame, basically tells you that a recession is coming up. And many economists have been talking about a recession in 2020. And so this is why everyone is really looking at this and really discussing it this week, because they're scared. And one of the other indicators is it possible that the stock market is at its peak? And we've seen with corporate buybacks on stocks, that's reached its highest level ever. So it's very possible that assets like stock prices and companies have really hit their peak. And it's going to be very interesting to see how this plays out this year.
And just to kind of add to that, the big question that on everybody's mind is, should I sell everything? And let's be specific. What they're talking about there's different stocks. And so, of course, the answer to that is no, because if everybody decided to do a big mass selling, then that in itself would drive the stock prices down just because there's more supply than there is demand. Now, again, our show is Keeping It Realty, right? So this is typically about stock. And so a lot of times people will tie the stock market directly to the real estate market, and one doesn't necessarily always beget the other, which is what we're going to kind of talk about a little bit here.
Yeah, and so taking this news and focusing on real estate, one of the biggest, I guess, the biggest pluses with this inverted yield curve is that we're going to see a drop in interest rates, which we've actually seen. I mean, we saw rates hit 5.2, right. 5.3 end of 2018, and now you have rates at 4% again.
Right. And in fact, again, we're keeping it realty, so we're talking about real estate. How does that affect the real estate market? So when the government is thinking that there might be a recession, they're not going to be raising the interest rates, not just on real estate, but also corporate debt. Because what they don't want to do is make it more difficult for companies to be able to operate, because the more difficult they make it to operate, then they're going to have to lay people off. Now, from an investor or a real estate investor standpoint, with the interest rates being low, what that typically will do is the cost of money will drop. And you've always heard me talk about cap rate. Cap cap rate takes into consideration the income that a property generates minus all of its expenses, taxes, insurance, utilities, management fees, but it does not take into consideration making a mortgage payment. So when the interest rates are lower, then your ROI now kicks in as a more prominent factor or another factor to decide whether or not an investment is good. So the lower the interest rate, the more that you can leverage your money, the higher your ROIs go up, right alongside your cap rate, right? In fact, you can actually have a lower cap rate, but if the price of your debt is lower, your ROI can still be high, and that's the power of leverage. So what does that have to do with real estate? If the interest rates do continue to stabilize or even decrease as a result of this potential panic, then it would be even a better time to start buying real estate and investing.
So with every economy, every upturn, downturn, there's always winners and losers. The key is to make sure you're on the winning side every time. So